Beijing has the ability to do is waiver some of the tariffs. It's more likely to waive tariffs for state-owned firms than it is for commercial firms. Thanks for joining me on the Comstock channel. I'm analyst Brian Grete, and we have a deal between the U.S. and China that was secured when President Trump met Chinese leader Xi Jinping in South Korea in late October. And we got some details from the White House over the weekend in terms of what China agreed to. They agreed to purchase 12 million tons of U.S. soybeans through the end of the year, so the remaining 2 months of November and December. They agreed to then buy at least 25 million metric tons of U.S. soybeans the following 3 years, 26, 27, and 2028. And so that is some of the details that came out. Now, China notably hasn't issued any of the tonnages, but China's finance ministry did say earlier this week that it agreed to roll back tariffs, and that's most of the tariffs. And there's a lot of numbers being floated out there in the marketplace. I just want to run through some of the specifics in terms of where we're at with tariffs versus where Brazil stands, and talk about some of those differences initially, and then look at prices and what this all could mean in terms of the buying. And then also other commodities are going to come into play. This isn't just soybeans. Soybeans obviously were the large part of the deal for the United States and a key component, but this encompasses other commodities as well. Okay, first the details, the tail of the tape, so to speak, in terms of how U.S. soybeans stack up versus Brazilian soybeans from a tariff perspective for Chinese shipments to China. And so the most favored nation tariff sits at 3%. That is the same for Brazil and for the United States. Also, Brazil and the United States and any other country that ships soybeans to China faces a 13% VAT, or value-added tax. And so in Brazil's case, you add the 3% and the 13%, and it comes to about 16% in terms of the relative rate that soybean shipments from Brazil face. The United States has that same 3% and the 13%, but there's an additional 10% tariff that's still in place from fentanyl duties that the United States charges to China. And so that is the difference. And the effective tariff rate for U.S. soybean cargoes going into China currently stands at about 26%. And so a critical difference there. So that extra 10% makes a difference. So when you look at export prices, add the 10% for U.S. cargoes, and you'll see how that comes into play. As you can see, U.S. soybean export prices just went premium on Monday to those from Brazil. And these are Gulf prices, so they may vary a little bit coming out of the PNW. Coming out of the U.S. Gulf and out of Paranaguá in Brazil, we saw U.S. prices go premium after an extended period of being below to well below what Brazilian rates were. And so that is a significant shift. And so what we saw is the sharp rally in U.S. soybean futures pushed the export prices to a premium to Brazilian prices. And they've remained there the following days after that. And so that one's a critical one. Now you add on top of that the extra 10% tariff that U.S. cargoes face going into China, and you can see that it's more economical to buy from Brazil right now for Chinese buyers than what it is for the United States. Now, we know that China's COFCO, state-owned COFCO trading firm, has purchased at least 5 cargoes of U.S. soybeans, either ahead of or right after the deal was done between President Trump and President Xi from China. And so those were probably somewhat goodwill purchases, to be honest with you. But the one thing that Beijing has the ability to do is waiver some of the tariffs. It's more likely to waive tariffs for state-owned firms than it is for commercial firms. In fact, it can easily waive them for state-owned firms, and it may be reluctant to do so for commercial firms. Well, what does that mean? Well, if commercial firms continue to face that extra 10% tariff on U.S. cargoes, we're probably not going to see a lot of commercial buying from China. In fact, they may not have any commercial buying. This may all be done through COFCO and other state-owned firms. Sino Grain is another one. Now, COFCO held a signing ceremony with the U.S. and China trade deal situation this week, and we just don't know the tonnages on that. It's been reported ahead of that it may be 5 million tons. And so if you take those 5 cargoes that we know that COFCO purchased, and you add them to 5 million metric tons that could have been signed in that signing ceremony, then you're talking about about 5.5 million tons. So China would still have to buy 6.5 million tons to get to that 12 million ton total that it agreed to, according to the United States. And so there's still a lot of purchases to come. Unless that extra 10% tariff is removed from U.S. cargoes, those purchases are likely to be from state-owned firms and not from commercial firms. So I've said it before, and this holds true, but a bushel or ton of soybeans going out the door to China is still demand. What comes into play in terms of who's the buyer, whether it's a state-owned firm or a commercial firm, determines when it's used. So the commercial firms will use it up front, short term, crush those soybeans, and it'll move into the animal feed sector. If it's state-owned firms, those soybeans are likely going to be dumped into state-owned soybean reserves for China to use for a quote-unquote rainy day service and when they need them. So there is a difference there in terms of usage. In terms of demand out the door is demand. A bushel or a ton is the same, no matter who's the buyer. It's a matter of how it's being used once it gets to China. Now, we also know that China's dipped its toes into the water somewhat on wheat cargoes and also sorghum. There's been talk in the marketplace for several days now that Chinese buyers were shopping around for U.S. wheat. And the question would be, well, why would that be the case when U.S. wheat prices are well above what international wheat prices are? So here you can see how they compare to several of our competitors, Argentina and the EU, France in particular. There don't have Russian prices on this chart, but Russian prices are cheaper. And so as you can see here, the US is priced above the competition at this point in time. So the 2 cargoes of wheat that China reportedly purchased recently happens to be a goodwill purchases. They're saying, hey, in good faith with the trade deal that we got done, we are going to buy some wheat. Now, there's also talk that 1 cargo of U.S. sorghum went to China as well. And once again, that would fall in the goodwill category in terms of they're purchasing more that they want to show that they will live up to terms of the trade agreement versus buying on value. And there's a significant difference. So anything that we see from a goodwill perspective is probably going to be rather token in terms of purchases. If it's because of value, and for China to see value, we would need to see our export prices drop below the competition. And in the case of wheat, as you can tell here, we're still priced well above. On soybeans, as you saw earlier, we are now priced above Brazilian soybeans as well. And so state-owned firms are likely to be the buyers until we see U.S. prices competitive against the competition around the world, and purchases at least for other commodities aside from soybeans, which the U.S. says China needs to get to 12 million tons by the end of the year, will be mostly goodwill purchases in terms of volumes from that perspective. So this is something that we need to watch on definitely a weekly basis and most likely a daily basis, because it can fluctuate from day to day based on what prices do. And so we need to get U.S. prices competitive. Now, it's kind of a catch-22 because as the farming community, we want prices to go higher so we have a better selling opportunity. But as prices go higher, so do export prices and make us less competitive as a whole versus our competition on the global marketplace, specifically to China. And so this is something that bears watching on a day-to-day and week-to-week basis. For the Comstock Channel, I'm analyst Brian Grete.
Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.